Well, hey there. It is Friday, so it's not Thursday, but we're going to do a 4 Minute Friday this week because I got some interesting data yesterday and I wanted to have a chance to digest it. I've got a regime shift from Goldilocks to deflation from 42 Macro, which is one of our primary research providers. And effectively, what that means is that we're positioning now for a regime that looks different. And it doesn't mean that it's going to happen imminently, like within the next couple of days. But I think we're running out of time on this market expansion, and we're getting closer to the place where the markets are going to have to digest some really big picture and I would say fairly serious data. So I want to start with the relationship between the Japanese yen and the US dollar. And so one of the things that's been happening is that the dollar has been weakening quite a bit against the Japanese yen. And that's creating some challenges globally for a variety of different reasons. But what's most important about this chart is that right back here, we saw that the markets got pummeled over the weekend when the Japanese yen hit this, roughly $1.43, $1.44 range against the U.S. dollar. And as you can see where we're at today, substantially lower than even the lowest wicked candle at that time. Now, this is not caught up with the market yet, but I suspect that it could. And the reason this is important is because I don't think the yen carry trade is over. I think there were some interventions, things stabilized, but I suspect that it's going to cause strain on the banking system. And the reason that I think this is coincidental or interesting is that just in the last 24 hours, the Federal Reserve chances of giving a 50 basis point rate cut instead of 25, meaning 0.5% instead of 0.25%, have gone up dramatically for next week. Now, when you think about it, why would the Fed be so aggressive with rate cuts when all of the economic data looks reasonably good and the stock market is within a couple of percentages of all-time highs? In fact, if you look at the stock market currently, all right, we just go down to the S&P 500 actually right here. And you can see that the all-time high was established back in July, and it was around 5,700, and we're at 56 and change right now. So I mean, we're within a percentage point or two of the all-time high. And the NASDAQ, not quite the same, but still, within striking distance of the all-time high. So it's hard to, understand or think about a scenario where it makes sense to cut rates if the markets are doing really well, which they are currently. And on top of that, the employment picture is still decent. The economic data is definitely deteriorating, but it is not even close to a recession. So why would they do this? And I think that the answer is that the banks have really been struggling in terms of the held to maturity assets that they have on the books that are really, really underwater. The longer that rates stay high, the more of a problem that becomes. And now we've got this bifurcation where if you look at, say, the 10-year Treasury, got to go back up here, that's all the way down to 3.648, and the 5-year Treasury, do I have it listed? I don't, but it doesn't matter. It's going to be in a similar range. So what's interesting is the 10-year Treasury is at 3.648%, but the federal funds rate, and I got to find it, so bear with me for a second, is still at 5.33%. So that puts a lot of pressure on banks because they're essentially losing money on the assets that they own. And because the federal funds rate is so high, but the other rates are lower, they're not able to collect as much interest as they should. So it's not a good scenario. And I think, if you take that coupled with the Japan the yen carry trade, okay, say that 3 times fast. And I think what this is hinting at is that there may be some problems in the global banking system. And I've heard some rumors about Nordschuken, SoftBank, and then possibly in, Credit Suisse still has, some challenging assets on their books. And so And also what's been interesting is that in the United Kingdom, a couple of the larger banks have really increased the level of their borrowing at the discount rate, which is kind of like the lender of last resort. So this is really, really technical stuff. I don't expect all of this to necessarily make sense. What you need to know, though, is that we are, I think, getting to the end of where the low-hanging fruit has been picked, and it's going to be time to be a lot more defensive. It doesn't mean that we run away from the markets, but it does mean that we're going to have to be much more risk averse. The last thing, and I know I'm going on a little bit longer here, but look at gold. Gold has been shooting up, and it's something that I think is important to note, and we're going to add to the portfolio here because I think this is the beginning, not the end. So gold is at $2,585 an ounce, and I think there are structural forces in place that will take gold maybe over 3,000, maybe even up to 3,500. That's not a prediction. That's just an observation that if the structural forces are what we believe they are, that's a possibility. And the reason that we believe this is because central banks are buying gold. Now, they're not trading in gold, but they're buying it and putting it on their balance sheet. And that's important because it's a sign that there may be some confidence waning in the U.S. dollar, especially as the United States heads into a rate cutting cycle and what looks like maybe a liquidity pump. And some of this might be political. I mean, the reality at this point is that the election's just a couple months away, and I would argue vehemently that both Jay Powell and Janet Yellen want Kamala Harris to be your next president. And so they're going to do what they can. And I think this is, in part what they can do is sort of juice the markets. Now, the problem with this is that the rest of the world is kind of picking up on it. And so they may not get what they want. In other words, the markets in general may not allow them to just print money and drive asset prices up. The markets might say, look, you're being reckless and irresponsible. The printing has gone on too much. The debt's too high. The dollar is starting to weaken, and which is good for trade and some other things, but it's not really good when you look at it on a long-term basis. And so gold looks like it could be a defensive proxy. The caveat being, and I'll say this, if we get a more severe and deeper downturn in the markets and the economy, gold probably will give some of those gains back, because throughout every major downturn that I've witnessed in my career of over 30 years now, gold sells off, if you get things get really scary. I'm not sure that we're there yet. I would say there's some things out there that are very concerning, but they're not, we're not at the place right now where we're ringing the alarms. We're just paying attention, we're being vigilant, and we're managing risk the way that we should. So we'll probably start moving out of the short-term treasuries, like 2 years. A 2-year treasury not everybody has 2-year treasuries in their portfolio. I'm just looking for it here. I got to find it. It's U2. There it is. Okay. So this has had a pretty significant run up, okay, as you can see here. However, I think we might be getting to the end of that as well. And so this might be a good time to shift some of that money into gold. And so in our advisory models, that's something that we're looking at quite closely, and we'll probably make that change in the early part of next week. Other than that, we're already doing a very good job of managing risk. We're not avoiding the stock market, but we are paying attention. And I want you to know that I think the low-hanging fruit has been picked. Doesn't mean that the market can't go a bit higher. It certainly can. And there are some strong structural forces as we get to the end of the year that could theoretically push asset prices higher. Okay, I don't want to sound like I'm talking out of both sides of my mouth, but you've got a few things going on here, which is what makes the markets difficult to read right now. And so, again, not time to get out, but definitely time to manage risk and make sure that if things turn, and they turn quickly, we'll be protected. And in the vast majority of instances, we already are, so there's not really anything we need to do there other than just be mindful. And if you've got money, outside of Sawchuck Wealth, things that are really heavily growth-oriented, or you've made some decent returns in mutual funds or stocks or managed money with somebody else, it might be time to have a conversation around, paring back some of the risk, not avoiding the stock market, but just being a little bit more conservative, because the risks, I think, are growing. Next week will be an interesting week. The Fed meets on Wednesday, and They're expected to cut rates. I think if we get no cut or a 50 basis point cut, the markets will not respond favorably to that. And the reality is a 25 basis point cut is already priced in. And typically, when the Fed starts cutting rates, that's the sign that the market run-up is pretty close to being over. The market runs up prior to the rate cuts. Once the rate cuts start, it tends to go the other way. Again, it's not like an immediate thing, but it doesn't take that long for that shift to change. So just understand that we're watching things very closely. I know this is not 3 or 4 Minute Friday, but this was a nice little flash update. By the way, we're having a town hall meeting on September 25th. That's a Wednesday at 6:30. Keep an eye on your inbox for that because we're going to go into a lot more detail about all the things that we see. It's going to take me about an hour to get through that, but there's a lot to cover, and I think it's going to be worthwhile. So I hope you can register for that. I think the email's already been sent out. So have an awesome weekend, and I will talk to you next week.